When starting out as an investor, it can be daunting to understand the different terms presented about companies, their earnings reports, and their outlook. Today I'll go through 3 books that I recommend reading before you can begin investing. I recommend reading them in full, but I'll give some of the key points from each book. Hi everybody, welcome back to the Contrarian. My name's Logan. I really like to talk about investing and success, as well as going against crowd thinking. Today I'll be talking about my favorite books when it comes to the topic of investing and learning about investing to start out. So if you like these kinds of topics, please hit the like and subscribe buttons down below. So the first book I'm going to recommend is the new Buffetology. It's obviously about Warren Buffett and his way of thinking. It's by Buffett and David Clark. It explains Warren Buffett's strategy and stock picking system in everyday English. And Buffett himself can be very reclusive and hard to understand at times, so this goes into much more detail than he would if you were to listen to any of the interviews he usually gives. This is a Value Investor's Book 101, so it's really, if you're into growth investing and really trying to pick the newest, hottest stock, this isn't the book for you. I really like to talk about value investing, so this is a really good book for that, but it focuses on fundamentals to look for that indicate strong companies. The original book is old, but the new Buffetology is more recently updated, and the older book doesn't all pertain to today, but it does give a way of estimating the future potential of a company. Some key points from this book. One is that the stock market sells on bad news and buys on good news, and Buffett does the exact opposite. I've been talking about this a lot. My first video talks about this, and this is kind of Warren Buffett's secret to success, but it's a very difficult thing to do at certain situations. So that's point number 1, big takeaway. Point number 2, most common price factor is pessimism. Buffett looks for pessimism in an industry. That's point number 2. I also talk about that a lot. 3, Buffett is willing to wait for the perfect home run pitch and let others go past him. So if he doesn't see just the perfect pitch that he knows he can hit a home run with, he's not going to swing at it. So Buffett likes to compare himself to a batter or a baseball player waiting on the pitching stand, and he's pretending that there's no such thing as not swinging at a good ball. He can let as many good balls go by as he wants, but as soon as he sees the perfect pitch that he knows he can hit a home run with, he's going to swing at that one and just let all the other ones go past him. So that really gives you insight into kind of the low risk tolerance Buffett likes. Point number 4, he looks for durable competitive advantages in businesses. And point number 5, he avoids infant industries and industries competing on price. So yeah, now let's get on to book number 2. Book number 2 is The Intelligent Investor. It's written by Benjamin Graham. This is probably one of the best read books on investing out there. Graham was Buffett's mentor, and this gives insight into what value investing has traditionally been. So The Intelligent Investor is a very old book at this point. You can probably find even PDFs of it online for free because it's definitely past its copyright date. It's definitely my number 1 pick if you could only read one of these books. This book, most of all, is a great way to look at potential companies to determine if they are based on solid fundamentals or merely hype. It is slightly outdated right now, I would say, but it shows where the current market is missing the point and likely what it will return to in the future. So obviously there wasn't such a thing as negative interest rates back when Graham was writing this book, but it does kind of show you where the modern market has kind of lost its mind right now and what it'll probably eventually return to. Point number 1 from this book, to pick the right stocks and outperform Wall Street, you need to pick companies that 1, have inherently sound and promising, and 2, are not popular on Wall Street. So this is kind of, again, what my whole channel is about. The Contrarian is going against crowd thinking, and that's a major theme for Benjamin Graham. Point number 2, a stock is not a good buy if it is near or at its justified valuation. So obviously you're trying to buy undervalued stocks. Graham goes farther to say that buying a stock that's at its justified value is not good enough. You have to look for stocks that are grossly undervalued. Point number 3, a stock becomes more risky as it rises in value and less risky when it falls. So this is really a contrarian way of thinking about it. Like buying Tesla stock right now when it's at $1,300 per share is much, much, much more risky than if you were to buy it a year ago when it was under $200 a share. That's pretty obvious, but it's hard to kind of enforce that in your mind when there's a lot of crowd behavior going on with just buying Tesla because it keeps going up and up and up. That's a very risky position. Intelligent investor dreads a bull market. So this really means that it's very, very hard, if not impossible, to find good deals, undervalued companies in the end of a bull market. So bear markets are actually what investors really love. That's when everything is at a great bargain discount. Book number 3, the final book I recommend, is Common Stocks and Uncommon Profits by Philip Fisher. This book is similar to the new Buffetology, but builds on it and gives 15 crucial points that describe a company with great market and product potential. He also gives 5 don'ts in investing, which are great to know as well. It's great to know, okay, what should I really avoid? What kind of thinking should I really avoid? He explicitly goes into that, which I really like. Point number 1, he gives the scuttlebutt method. He calls it the scuttlebutt method. It gives 15 good signs to look for in a company. Some of the notable ones are, is the company in a position to grow? What is it doing to improve profit margins? Does it have a short or long range view on profits? And does management have integrity? These are great questions you need to ask yourself when thinking of buying a company's stock. Point number 2, 5 don'ts. Don't buy into promotional companies. Avoid buying a common stock because it's too common. So don't think, oh, everyone's doing this, I shouldn't do it. That's another thing you shouldn't fall into. You like how it looks as a company, but you don't like its fundamentals. Don't do that. You have to look at fundamentals over its appearance. Assuming a stock is already as discounted as it could be. So you really, again, need to take into account macroeconomic fundamentals and factors that could play in and could discount a stock's price even more. And also don't diversify. And this is really shocking because people always assume, oh, you have to diversify. That's kind of the common, most given advice by most people. But Fisher really goes into why this isn't a good idea. If you're diversifying, there's no way you're going to outperform the market. That's by definition what like an index fund or mutual fund is doing. It's just spreading you across the entire market. So you're going to rise and fall with the market, but you can't outperform it. So that's a big don't for him. And then another big don't he gives is don't follow the crowd. And that's what I really like to talk about on this channel. If you really like these topics, hit the subscribe and like button. It helps me to continue making content like this. And I hope to see you again.